Hey everyone, this is Kirk here again at OptionAlpha.com. This is the members only video for June 19th after the close today. So today's Fed Day. Bernanke speaks again, and we always watch and see if he coughs or if he sneezes and what does that mean for the market. And so everyone gets so wrapped up in this, but at the end of the day, the real gist of what they're talking about and what they said today is that they're going to continue the bond buying program, but they are going to taper it off in 2014, which we already kind of thought was coming. So really no new news that came out today. But I did want to go over our current portfolio because we're getting real close to June expiration, especially for the TLT bond trade that we have on, the short 112, 111 put spread. That's really close to the short strike. So I want to talk about what we're going to try to do with that one tomorrow. And then also want to cover the DIA and the EWZ trade as well and kind of go over, again, because I had a lot of these questions pop up over the week, is why the mentality of entering these trades. Why are we entering these trades and taking these credits, and what are we doing here? So it's important that you please watch the whole video, take notes, rewatch it, come back and rewatch it again, because I'm going to cover a lot here, and so I want to make sure that everyone follows along. If you don't understand the first time, again, you can just rewind back and check it out. So let's go in here and take a look. The first thing is the DIA trade for July. We're short the 156, 157 call spread. So that's somewhere up in this range right here. So it's actually doing still fairly well. Volatility has come up a little bit against us, but actually today crashed back down. So with the lower close today, absolutely in the diamonds, then that's actually a good move for our position. It's actually pretty well balanced right now and really where we want it to be for the market. Let's quickly talk about, before we talk about TLT, is EWZ. So this is the Brazil ETF EWZ that we are short, the 45.44 put spread. So you can see today we had a huge down day in this market, almost 3.5% down, which crashed all the way down near our short strike. But here's the thing. When we entered this trade, we took in a great premium. I think it was around 29 cents to 30 cents, depending on where your fills were, per $1 spread. So it's still a 70% chance of success trade when we entered it. Now, of course, do we like that the index has moved against our position? Absolutely not. But we have an entire month ahead of us, and it's defined risk. So at the end of the day, you can see down here where volatility has been trading. And volatility is at the absolute top end of the range over the last 2 years. You can't really say that much about anything else. There's a couple of things like the yen and some of the other stocks as well. But really, even though there's a lot of uncertainty with Brazil, nobody knows what could happen. And that's the real end result. So all we have to do is trade the probabilities and consistently make trades that fit both our probability requirement, making trades that are high probability success, and then also selecting strategies that have the right appropriate entry for the market that we're in. So in this case, it would be a bad idea, and let me just tell you guys about a bad idea, would be to buy a call or buy a put in this case, because what you're doing is you're buying volatility when it's at its highest point. In this case, as option sellers, what we want to do is we want to sell volatility when it's at its highest point or near its highest point. So when we entered this trade just a couple days ago, it was still at a very, very high point in volatility. It's gone up a little bit since then, but over time, volatility is going to get crushed in this thing. Now, will the stock go up? Will it go down? We don't really know right now, but it's a good probability trade. And if you make 70% probability trades over time, and you have volatility that's in your favor, that meaning you're not selling options when volatility is low and could go higher, then over time you start making these trades, you're going to make money on these trades. I guarantee it. Let me give you an example of one that I would not sell a credit spread or a put spread on, and that's USO. USO volatility, you can see down here in green, this is implied volatility, is down at the low end of the range. So there's no reason for us to sell options in USO right now. Could you do it? Yeah, you sure could do it. But you'd have to get really close to the market and take a lot more risk than you actually should. And if volatility pops up, that also hurts your position. So this is an instance where you could possibly buy a single leg option, like buy a call or buy a put, whatever direction you think the market's going, because you have volatility that could be rising, and that's favorable for that type of strategy. So in options trading, and I want to drive this home, and I know I haven't done a good job of it, but I'm going to try to do it more on these videos, is that we always have to look at where volatility is and then make the right strategy selection for that particular market. And that is what makes a successful trade. Trading the wrong strategy in a high volatility environment, you might as well throw money away, because over time you're going to lose money. So could you be right a couple times? Sure. But over time you're going to be trading against the prevailing market, which is that volatility should go down if it's from a high environment, and volatility in a low environment should go higher. So you don't want to trade against those. You want to kind of trade with those. So hopefully that makes sense. And as always, feel free to email me comments and questions. Let's get to TLT. So again, TLT has seen a pretty wild ride over the last couple months. We actually entered the trade here when the market had a big down move. So it's actually trended lower, but again, it's starting to lose value every day that we get closer to expiration. Today, again, our strikes are at 112 and 111. So our short strike is 112, long strike 111. Since we entered this trade for a 30-cent credit, our actual break-even point is 111.70. So we just take the short strike minus the credit that we already received. Really, we need TLT to close anywhere above 11.70. So again, we're right on that cusp right now. But let me tell you what I think we should do with this trade. I still like the trade overall, and here's where actually a roll is going to come into play. So I actually think that this is a great time to actually roll this trade. I don't think it's a good time to hold until expiration. We're kind of really close. Unless the bond market really jumps higher tomorrow and is up in the 13s, maybe we'll just hold it and see if we can capture some profit. But I actually like this trade for July. So what I want to do is I want to roll this trade to July, keep the same strikes. That's going to keep our margin requirement exactly the same, because we're not changing anything with the strikes. In fact, actually, margin is going to go down a little bit. But we're not changing anything with the width of the strikes or where they're located. We're going to keep the exact same strikes, and we're just going to give ourselves some more time for the market to kind of adjust and be right. Now, again, we're still selling in a high volatility environment. So at the end of the day, this still meets our criteria. If volatility had completely crashed in TLT, and the pricing was just like it is right now, then maybe that's not a good opportunity to actually roll the trade and resell it for the next month. So right now I think it's actually a good time to roll the trade. We're going to try to capture some more premium and see what we can do for July. So let me go over what that's going to look like. I have up here the TLT chart, and what you want to focus on is you want to focus on this down here. This is my current position, so I'm actually short 2 of these spreads. It's a fairly small position, but I want to keep these light. And you can see that there's only 3 days left to go. Really 2 trading days left to go. Now I enter this trade at an average price of $29.50. So call it 30. And right now it's trading for around 8. So what we want to do is we want to make sure that when we roll this trade that we take in more credit on the roll. Because again, the key here is that when we roll, we're extending our time for this trade to move, but that also means that we want to take in some more credit and make some money on this trade. So all we have to do in the Thinkorswim platform is actually go right next to the box and click Analyze Rolling Trade. And what I'm going to do is I'm going to click here, the Sell Vertical Roll TLT July, June 112, 111 put spread. So what this is going to do is it's going to simulate closing this trade and reopening the exact same strikes in July, again giving us some more time to be right. So here's what that trade looks like. Actually, there's 2 of them up because I was doing this before this video. Delete one of them. So here's what this trade looks like. Again, down here, our current position, and then the new position, which is closing it out. So you can see our trade becomes still a credit spread, but in this case, it becomes a little bit more centered because we took in a higher credit on the roll. So you can see on this particular roll, right now, the credit is about 16 cents per contract. I'm probably targeting tomorrow around 15 cents. That's pretty healthy credit, but we may even take lower on that. So if we add 15 cents roughly to our 30-cent credit, that gives us an overall credit at the end of the day, if it does actually expire worthless in July, of 45 cents. Now, since the spread is only $1 wide, that makes our risk only 55 cents. So we took in 45 and we're risking 55. So you can see it's a much more balanced trade, and that's because TLT is right near our strikes. But again, the idea here is that we're extending the amount of time that we have to be right, while also taking in more premium to compensate us for that extra time. So my ideal situation in this case would be that TLT has a slight rally from these levels anytime in July or the end of June, has a slight rally from here, and we close the spread out, taking in probably about 15 to 20 cents of credit. I don't want to keep the trade all the way till expiration and try to capture the whole 45 cents and make a pretty big return on that part of the investment. But I just want to capture the move when TLT is going to have some cyclicality. It's going to make some moves up and down, and the credit is going to start to diminish. So again, that's really the target, is to get back some of the credit that we're going to take in here and close the trade before July expiration. So hopefully that makes sense, what we're trying to do here. Again, the whole idea with this roll is that we're rolling in an environment that's still high volatility, and that's the key. We're still rolling in high volatility. You would not roll this trade into a low volatility market. That just doesn't make sense, because you wouldn't just enter that trade like it was new. So that's what we're going to try to do with TLT. At the end of the day, this is still a good trade, and we'll just take it day by day. But please be on the lookout for the alert for that. But as always, I hope you guys enjoy these videos. I'm trying to add a little bit more into these videos, and as always, please email me your questions, comments. I want to make sure you guys are understanding this stuff. There's a lot out there, and I think with the recent moves that we've had in stocks, I think there's going to be a lot of stocks that are going to start to show up on our radar as potential trading candidates. Namely the Qs, IWM, and DIA, I think are still going to be some great trading vehicles here in the next coming weeks. So, as always, hope you guys enjoy these videos, and happy trading.